Hello and welcome to another episode of Darwin Investors. Today we're going to talk about how I've been doing in the stock market, what I've been doing to navigate these current market conditions, and we're going to briefly take a look at a company called Cleveland-Cliffs that reports earnings this Friday. Then that led me into what an economic recession is. What exactly is a recession? Where are we, or at least where do I believe we are in the current business cycle, and how I plan to play the stock market, going forward. So there's a ton to unpack here. So let me go ahead and share my screen and we'll get started. So last week, you can see from January 31st through the 4th of February, I made $3,962. And if you've been paying attention or following along on this channel, you'd probably assume, and you'd be right, that I made a lot of it on UPS and earnings. Now, I was able to make so much money because, there's a risk involved. And though I made money, I could easily have lost money too. So on this trade, I ended up making $3,385. I did it by selling a 195 strike put that expired on Friday for $399. I ended up buying that one back for 12 bucks. So I made $387 on that put. And then I made about another 3,000 on my shares. I bought the shares for $199 and I sold them for $229 because UPS was lights out at earnings. And why do I think that? Well, one, I love UPS because it's kind of like a monopoly. It's not a monopoly, but you don't have a lot of choices. You have the Postal Service, you have FedEx, you have UPS, and these are sort of the kind of companies that I'm gravitating towards right now, are companies with very little competition. Secondly, retail sales were really high in December, so I thought I'd take a chance. And now I could have sold a covered call to get out of this trade, and that covered call was only going to go for $104. So I did not like that option. Instead, I opted for a 1% trailing stop, which actually worked in my favor. So when UPS was at $223, I said I will sell all my UPS shares, because at that point I was up about $2,500 with the put, the sold put included. And I thought that was good enough. And so I set a 1% trailing stop at $223. But the way a trailing stop works is if the company just keeps going up and up and up, it does not trigger a sale of the underlying stock until it backs up 1%. Well, by the time UPS backed up 1%, the price of the shares were $229.40, which got me a profit of $3,385 last week on this particular trade. Then I rolled all this trade into AMD because these companies, with the exception of Intel's, seem to shoot the lights out. A lot of people think these semiconductor stocks are cyclical, but I find that they're good every single quarter. Maybe they used to be cyclical, but they just haven't been lately. So with the exception of Intel, you're talking about AMD, Qualcomm, NVIDIA. These guys always just shoot the lights out when it comes to earnings. So I rolled some of this money into AMD, and I made another $700 on AMD. And then let's go ahead and take a look at Cleveland-Cliffs, because this was a company that I was going to play earnings on. So I was already up some money from last week. I was up almost 4,000. So let's see if we can't keep this rolling and play earnings on Cleveland-Cliffs. And when I look at Cleveland-Cliffs, they're a steel company. In case we don't know, they're a steel company, sort of like a Nucor. And if I look at their 9 months ended, looking at their 10Q here, they made $15 billion 9 months ended September 30th. That's way up. I mean, I don't know how many percent that is, 500% from 2020. We look at their net income. They lost $155 million in 2020, and their net income was a gain of $2 billion in 2021. This seems like a company that's rolling. This seems like the sort of company that you want to get into. It's like, okay, I'll take my chances, I believe, with Cleveland-Cliffs. Then I started seeing some red flags here. Why is it a company that is on fire like this has gone from like $24 down to $18? This company has a price to earnings ratio of 4.86. I tend to stay away, or at least raise an eyebrow whenever I see something this low. It's like, okay, It's trading really, really low. Why is it so low? It's sort of like why I don't trade Citibank. It's the cheapest of the bank stocks by valuation, but there's a reason people do not like that stock, and it's consistently the lowest. So this raised an eyebrow. I looked at, say, a 5 year. You can see it used to trade down here right around $3-4, and we know why. It was losing money, and all of a sudden it started making money, so it ran up the ladder. You can see if you look at something like Newcorp, it's done exactly the same thing. It was down here, it was probably losing money, and it ran up the ladder. So what's going on with Cleveland Cliffs? So when I was looking more into Cleveland Cliffs, it says weak Cleveland Cliffs may be signaling a recession risk. And so exaggerated weakness since October in Cleveland Cliffs has a 50% correlation with economic recession over the last 2 decades. So basically, the steel industry is sort of like the canary in the coal mine for an economic recession. And we'll get into that in a little bit when we discuss recessions. Steel industry demand may have turned sharply lower since December. Now, I'm not guaranteeing that Cleveland Cliffs is going to have a poor earnings this time, because and neither are they. They're pretty wishy-washy. They may have turned sharply lower. Cleveland Cliffs may shoot the lights out. It may be a good one, and I think the downside risk for it is not that far. But remember, we're talking about a company that has come down. It's come up from $3, so it could have quite a ways to drop. It's been there before. Betting on a quick recovery in steel-making stocks may seem risky at this stage, and so I'm going to take their advice and not bet on them. Cleveland Cliffs has been exceptionally weak since it became clear in early November that the Federal Reserve was serious about fighting inflation and puncturing the stock market bubble through higher interest rate policy in 2022. If you are looking for the proverbial canary in the coal mine warning of approaching economic hardship, the drawdown in CLF is truly concerning. Further related steel names have also come under dramatic selling pressure, even as rising quotes continue for base metals and energy commodities. Believe it or not, there is a history of sharp steel sector underperformance we can research over the last several decades. My conclusions: similar rapid declines in the steel industry are 100% correlated with flat to lower S&P 500 quotes and associated with recession about 50% of the time. Using the last 6 instances since 1999, so yes, risk of a 2022 recession may be more reality than fiction, despite mainstream economist optimism on Wall Street to start the year. So what is a recession? So I started digging into, what exactly is a recession? We throw around the word, but do we really know exactly what it is or who's defined it and what it is? So let's take a look at it. So recession is a significant decline in economic activity that lasts for months or even years. Experts declare a recession when a nation's economy experiences negative gross domestic product, rising levels of unemployment, falling retail sales, and contracting measures of income and manufacturing for an extended period of time. Recessions are considered an unavoidable part of the business cycle or the regular cadence of expansion and contraction that occurs in a nation's economy. So we're going to go over where I believe we are in the business cycle. We'll take a look at the business cycle, but let's take a look at some of these things here. Could we have a negative GDP? Well, if we look at it here, GDP grew at 6.9% to close out 2021, which is way stronger than people thought it was going to be. Is it possible that year over year, let's say the fourth quarter of this year might be less than this? I think that's likely. So remember, we're going to compare year on year. So it doesn't mean that all is bad. It just means it wasn't as good the following year as it was the previous year. Rising levels of unemployment, we haven't seen that yet. When we saw the newest jobs report, it was actually very powerful. It was 467,000 gain in payrolls in January, despite the surge in Omicron. So that hasn't shown up yet. Falling retail sales, that is showing up. And contracting measures of income and manufacturing for an extended period of time. Manufacturing decline is showing up as well. That was in a latest PMI report that just came out in December, that there's not as much demand as there used to be. They're having a harder time passing higher prices on goods because there's just simply not as much demand as there was. And that might not be awful thing, because it's certainly going to clear up a little bit of our supply chains, through not as much demand, but nevertheless, it's all that one's already happening. Contracting measures of income, falling retail sales, that might actually already be happening too. I mean, we saw Facebook or Meta Platforms as in their earnings report with their weak economic forecast was sort of a signal that small business is not looking, they're not ready to spend as much money on advertising as they once did. And why is that? Well, they're not having as many sales as they used to have, or at least what they've been accustomed to having in here the recent past. So there might be a decline in some retail sales coming up. So what's the official recession definition? Well, during a recession, the economy struggles, people lose work, companies make fewer sales, and the country's overall economic output declines. The point where the economy officially falls into a recession depends on a variety of factors. So there's two different people that define this recession. One is this economist named Julia Shiskin, and the other is the National Bureau of Economic Research. And so they have two different definitions of a recession. Shiskin defines a recession as the most popular was 2 consecutive quarters of declining GDP. So 2 consecutive quarters of declining GDP. And what that tells me is that a recession is a bit of it's a trailing economic indicator. You already have to be in one for 6 months before Shiskin would say that you're in one, because he's looking at the past 2 quarters to say you're in a recession. So is it really that we're predicting a recession, or is it that you're just kind of looking at the world around you and saying, are we in one right now or not? Because they won't officially declare it till you've been in one for 6 months. A healthy economy expands over time, so 2 quarters in a row of contracting output suggests there are serious underlying problems, according to Shiskin. This definition of a recession became a common standard over the years. Now, the other standard is the National Bureau of Economic Research, and it's generally recognized as the authority that defines the starting and ended dates of U.S. recession. So they're the ones that have to say, okay, one has started, one has ended. Enber constitutes a recession, namely a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retails. So they would say, Enber would say, we've already been in a recession. And so I can kind of see the argument for both of these. One is like, well, you don't want to call it recession too soon. And these guys tend to call it a little bit quicker. And they would say that we were in a recession already in April of 2020 when the economy slowed down due to COVID. So what causes recessions? There is more than one way for a recession to get started, from a sudden economic shock to fallout from uncontrolled inflation. So sudden economic shock that we've just seen here recently would be the coronavirus outbreak, which shut down the economies worldwide. That would be a reason that we might go into recession. In fact, the Enberg did say we went into recession. We would have excessive debt, and that's businesses just taking on too much debt, growing defaults and bankruptcies. That hasn't really happened yet. The housing bubble in the mid-aughts that led to the Great Recession in a prime example of debt causing a recession. I wouldn't think that we're in a housing bubble, so to speak, right now. I think what we are right now is more of an asset bubble. This is where I believe we are here in this recession cycles. When investing decisions are driven by emotion, bad economic outcomes aren't far behind. Investors can become too pessimistic or too optimistic during a strong economy. Former Fed Chair Alan Greenspan famously referred to this tendency as irrational exuberance in describing the outside gains in the stock market in the late 1990s. Irrational exuberance inflates stock market or real estate bubbles, and when the bubble pops, panic selling can crash the market, causing a recession. So this is kind of where I think we're something like this at the moment. Too much inflation. Inflation is the steady upward trend in prices over time. Inflation isn't a bad thing per se, but excessive inflation is a dangerous phenomenon. Central banks control inflation by raising interest rates, and higher interest rates depress economic activity. Out of control inflation was an ongoing problem in the United States in the 1970s, and some say that it is right now. And to break the cycle, the Federal Reserve rapidly raised interest rates, which caused a recession. Too much deflation. We're certainly not going through that right now, unless you maybe count maybe some of these electronic goods like televisions and computers and I don't know, stereos. They don't seem to have gone up much in price over the last 30 years. And only recently have used cars started to go up at all in the last 30 years. So I would think that that outside of consumer electronics and automobiles that we've been seeing very much deflation at all. Technological change, that's something that's going on. Like today, some economists worry that AI and robots could cause recessions by eliminating whole categories of jobs. And if you look at a stock like UiPath, that whole stock is dedicated to eliminating people's jobs. It's essentially taking automated tasks that you can do through AI and just eliminate people's jobs using their technology. So that is a thing that's happening. Recessions in the business cycle. The business cycle describes the way an economy alternates between periods of expansion and recessions. As an economic expansion begins, the economy sees healthy, sustainable growth. Over time, lenders make it easier and less expensive to borrow money, encouraging consumers and businesses to load up on debt. Irrational exuberance starts to overtake asset prices. And we're going to go over more of this in just a minute. So let's get on down here is how long do recessions last? And now I'm going to start to give us a silver lining here to all this. I know it sounds like all doom and gloom. It's not as awful as it sounds, and there are ways to get through this. One is through patience, which I don't have a ton of, I guess. And another is through having a lot of cash on hand and being able to buy the dip, not on garbage stock, but on real stock that with real companies, with real earnings that we look at now that they've been cut and slashed in price that are a good deal, like Google. So we're not in the Great Recession, it's not like this huge banking crisis and, Lehman Brothers isn't going out of business and JP Morgan's not going out of business. We're not here, but you can see even in this awful, awful one here, this one lasted about 18 months, it looks like. The dot-com recession, this is, I think, similar to the one that we're in right now. And you can see that this one only took 8 months to bounce back from. And so at the turn of the millennium, the US was facing several major economic problems, including fallout from the tech bubble crash, which we kind of had with a lot of these SPACs and a lot of these no income companies getting evaluated to like 100. Look at Snowflake, 100 times sales, or like Zoom or something. And Zoom's not as bad as some of them now, but at least they have earnings now. But we've already undergone something a little bit like this tech bubble crash. I've been doing it now for about a year. And accounting scandals at companies like Enron. We had one accounting scandal at Luckin Coffee, but that was not in America. Capped off by the 9/11 terrorist attacks, which we could say that maybe Omicron or whatever would be kind of like an attack on our economy. Together, these troubles drove a brief recession, which the economy quickly bounced back. And this is kind of where I think we might be headed or currently are. Can you predict a recession? Well, the short answer is no, you can't really. But there are certain clues, and one is this thing called an inverted yield curve. And let me just go ahead and look at this inverted yield curve here. So what we're saying is that when we talk about an inverted yield curve, we're talking about between the 2-year and the 10-year bond rates. So essentially, we're saying that if you take out a loan that's 10 years out, you should be taking out more risk, and they should pay you more money than taking one out, say, at 3 months. However, when you think that a recession is on the rise, you're saying that we believe that letting you borrow money from me now is more risky than letting you borrow money from me in 10 years. So we're taking on a higher risk that you're going to pay it off with interest sooner than we are if you wait longer down the road, because that's so for this reason, an inverted yield curve, when a shorter term loan looks more risky than a longer term loan, that would be an indicator that a recession might be on the way. So what they're saying is, but when long-term yields are lower than short-term yields, it shows investors are worried about a recession. So this phenomenon is known as a yield curve inversion, and it has predicted past recessions. And this is kind of what we're going on right now. Like the 2-year and the 10-year are sort of closing in, where they used to be about like 1% different. Now they're about 0.6 different. So we're seeing an inversion of the yield curve. We have not yet seen, I don't believe, maybe we have, but declines in consumer confidence. Maybe we are getting a little bit of this actually. I mean, I'm not deterred. I'll still buy stuff, but as I ever did, but I was never an exuberant spender anyway, so it's not like I'm deterred because of any inflation or anything. It's just I've never bought a lot of stuff to begin with. A drop in the leading economic indicators, and so this is where we start looking at ourselves here. It looks at factors like applications for employment insurance, new orders from manufacturing, and stock market performance. So we're seeing a drop in the stock market. So we definitely are there. If the LEI declines, trouble may be brewing in the economy. Sudden stock market declines. A large sudden decline in stock markets could be a sign of a recession coming, since investors sell off parts and sometimes all of their holdings in anticipation of an economic slowdown. So this is kind of what I do to like some degree is I hold a little bit of my money. Since investors sell off parts, which I do, I just sold off my Union Pacific last week, and sometimes all of my holdings, which I never do, in anticipation of an economic slowdown, because I'm trying to sell off little parts that are winning and keep some cash and look for opportunities. Rising unemployment, we haven't gotten that yet. Okay, so how does a recession affect you? You may lose your job during a recession. That's awful. Investments in stocks, bonds, real estate, and other assets can lose money in a recession, reducing your savings and upsetting your plans for retirement. Even worse, if you can't pay your bills due to a job loss, you may face the prospect of losing your home and other property. All this is very, very grim. But if you plan ahead and prepare for a recession, it can be a frightening experience. If there's any silver lining, it's that recessions do not last forever. And so you can see that the dot-com bubble, which probably is the most similar thing that we have now, is to this current time, didn't last that long. It lasted about 8 months. So where are we in the business cycle? So the business cycle has expansion, peak, recession, and in some cases, depression, but in all cases, a trough, and then expansion, and then a peak, and so on and so forth. So where are we right now? Well, I believe, and again, I'm not a financial advisor, but just looking at the world around me, I believe we're here. We're here at peak. So we're about to head this way and find a trough. Now, it may not be clear down here, it may be right here and zip back up. But in any case, I believe that we're here, and let's see why. So expansion. The line of cycle that moves above the steady growth line represents the expansion phase of a business cycle. In the expansion phase, there is an increase in various economic factors such as production, employment, output, wages, profits, demand, and supply of products and sales. We've certainly seen all of that. In addition, in the expansion phase, the price of factor of production and output increases simultaneously. In this phase, debtors are generally in good financial condition to repay their debts. Therefore, creditors lend money at higher interest rates. This leads to an increase in the flow of money. In expansion, due to increase in investment opportunities, idle funds of organizations or individuals are utilized for various investment purposes. Therefore, in such a case, the cash inflow and outflow of businesses are equal. This expansion continues till the economic conditions are favorable. And so I would say that here recently, I would say that we've had an expansion in employment, production, output, wages, profits. Look, I mean, just look at what the numbers these companies have been showing us in their 10Qs every quarter. But then we had Facebook, and then Facebook took a rapid decline. And why? Because they did not paint such a great outlook. And to me, Facebook is our real canary in the coal mine, that we're kind of like here. So Facebook didn't have a bad quarter. They made $10 billion, I want to say last quarter, which is bigger than most companies would ever think of making. And so they actually had a pretty good quarter, but what they did was they gave poor guidance, only 3 to 8% growth over the year. And people are accustomed to Facebook growing a lot faster. And they said they were not growing as fast because retailers weren't trying to advertise as much as they had been. That was the big thing. And then I guess TikTok was cutting into some of their revenue as well, some of their user growth. But their bread and butter is advertising, and that's showing a slowdown. So the growth in the expansion phase eventually slows down and reaches to its peak. This phase is known as peak phase. In other words, peak phase refers to the phase in which increase in growth rate of business cycle achieves its maximum limit. In peak phase, the economic factors such as production, profit, sales, and employment are higher but do not increase further. In peak phase, there is a gradual decrease in the demand of various products due to increase in the price of input. So, this is actually not awful that there's going to be a gradual decrease and that's what's showed in the PMI data in the demand of various products. So that's going to help our supply chain. We're not going to have to worry about that much longer because we're not going to want to buy as much stuff. So the increase in the price of input leads to an increase in the prices of final products, while the income of individuals remains constant. We've had a little bit of wage increase, but it has not been able to keep up with the increase in the price of final products. This also leads consumers to restructure their monthly budget. As a result, the demand for products such as jewelry, homes, automobiles, refrigerators, and other durables starts falling. So this is where I think we are right now. We're kind of at peak phase. Then we have the recession. As discussed earlier, in peak phase, there is a gradual decrease in demand of various products due to increase in the price of input. When the decline in the demand of products becomes rapid and steady, the recession phase takes place. So this is kind of where I think we might be headed, is into the recession. And then finally, you break down into the trough. During the trough phase, the economic activities of a country decline below the normal level. In this phase, the growth rate of an economy becomes negative. In addition, in trough phase, there is a rapid decline in national income and expenditure. In this phase, it becomes difficult for debtors to pay off their debts. As a result, the rate of interest decreases. So we should see, after our interest rates rise, we should start seeing rapid interest rates going down, and then that's going to be a signal that we're at our trough, and then it's probably okay to come back in the market again full throttle if that's your investing style. I tend to do it a little bit differently, which I'll get to in just a minute. So therefore, banks do not prefer to lend money during the trough phase because interest rates are down. They were doing well before, and now they don't want to give you money because they're not making as much money on the loans. So consequently, banks face a situation of increase in their cash balances. So now banks are kind of stockpiling cash. They're not giving out as much loans. They're kind of waiting for a bottom, and they're ready to come back into what? The stock market and the bond market. So they're kind of holding on to cash, if you will. And I would like to think that that's what we're doing kind of at this time. We're sort of like little mini banks. Let's start thinking about that. We don't want to send all of our money out. We send out some, some of these loans are good ones. Send out some, but don't send it all out, and just keep some cash balance on hand. Apart from this, the level of economic output of a country becomes low and unemployment becomes high. Let's hope this doesn't happen, but unemployment will become high because profit margins are hit because wages have gotten so high. And then where do you cut your wages from? Where do you cut your bottom line from? Well, you start getting rid of certain jobs, and then that would cause the unemployment spike. But we haven't seen that to this far. So far we've been lucky in this regard. And then in this regard also, we're saying that maybe we're not in a true recession. It's all very, it's all very fleeting. Like basically, we don't really know these things. You ask any economist whether we're in one, you ask 10, you might get 10 different answers. You probably would. So finally, you get a recovery phase. As discussed above, in the trough phase, an economy reaches to the lowest level of shrinking. The lowest level is the limit to which an economy shrinks. Once the economy touches the lowest level, it happens to be the end of negativism and the beginning of positivism. This leads to a reversal of the business cycle. As a result, individuals and organizations start developing a positive attitude towards the various economic factors, such as investment, employment, and production. This process of reversal starts from the labor market. So I believe that basically we're here at peak phase, and we might be getting pretty close to the recession phase. At least that's the fear for companies like Cleveland Cliffs, and that seems to be it does kind of seem like the direction that we're heading in all honesty. It doesn't seem like the end of the world. These things are kind of short-lived. So what am I doing to navigate this market? Well, I'm basically not going to worry a whole lot about the macroeconomics. I'm just going to carry on as I do. But what I generally do is I tend to keep a pretty good large cash balance. I tend to get in and out of stuff faster. Now, with our current pace, I'm getting in and out even faster than I used to get in and out. I have some steady stuff that I stay invested in, but by and large, a lot, like half of my portfolio is just like on rotation. And when I go cash, sometimes I don't just go all cash. Sometimes I'll take a look at what an opportunity is, and let's say it's in banks. I'll just take my cash and I'll put it into, say, JP Morgan and Bank of America or something like that, and then it'll function as cash. And in the meantime, I can get little dividends along the way. But right now, it's just like this rate of economic downturn, it seems, is happening so quickly that I'm just like bouncing through, and I'm like making all of these earnings bets, and I'm pulling out cash and I'm putting it into something else. Like right now, I just put it back into AMD. I'm waiting until NVIDIA reports earnings, and so I'm thinking that AMD will get an earnings, like a sympathy bounce on NVIDIA earnings, and plus they're going to go up with them because they're part of ETFs, like semiconductor ETFs that NVIDIA is part of. And when NVIDIA reports on the 16th, I would expect AMD is going to go up in price. At that time, I'll sell my AMD, collect that cash. I'm gonna roll a lot of that cash into Google stock if I haven't already done it by going out on margin with that. And then after that, Lowe's reports earnings the following week. And then Lowe's is going to be another one I'm going to play earnings on. I already own Lowe's. I'm going to sell a put on that if it stays at this low rate. I have no reason to believe Lowe's will not report well. D.R. Horton just had good numbers. Tractor Supply Company just had good numbers. So it follows suit that Lowe's will probably have pretty good numbers this quarter also. So those are my plans going forward. I tend on like hopefully trying to get anywhere between like $300 and $400 and $500 a week every week until we can work our way through this. I expect that we'll be through this, oh gosh, by the fall anyway. We may not, but this is my feeling, is that this will last about 8, 9, 10 months, and then we'll be on the other side of it. We will have hit our trough, and we'll start feeling more positivity and less negativity in this market. So if you got anything out of this at all, please like, subscribe, hit the little notification bell. Until then, we'll see you next time. Bye.